All right, Mark. So my portfolio, you said it was made up of dividend payers, dividend growers, companies that don't cut dividends, that either maintain them or grow them over time.
Quality companies.
Quality companies, strong balance sheets, healthy earnings, even growing revenue streams, earnings at the bottom line of the income statement there. So what's going on? My portfolio is on return 2% this year. The Nasdaq's up 20%. Why would that be?
Oh, lots of reasons. First is Nasdaq had a lot of ground to make up. But don't forget that we were way down in 2022 on the Nasdaq, which is sort of like that's just how that thing works, man. It's up and down. It's very aggressive. You got a lot of tech stocks. Just for equities in there that it's for young blood that has a long time frame, and so for growth investors, fantastic. I mean, you want to be there, and that looks great. But it depends on where you're at in your sort of your investment life right now. I mean, is it are you older? Are you retired? Whatever. These interest bearing, big quality stocks, the multinationals like you're talking about are the place to be. Look. Things go in different ways, and there's always, like you said, a gold rush right now. It's AI, right?
Yep.
Artificial intelligence is the big talk, and it's really with the Nasdaq. What's interesting is you only got 5 or 6 stocks that have actually really done a lot of the dirty work. The breadth has been really narrow, and that's actually concerning longer term for the overall markets. We'd like to see that all stocks participate. But so that's good for growth, but yet it's kind of concerning at the same time regarding what the overall markets look like. But I think again because you had a lot of makeup to do there. We're coming up on right now the Nasdaq is coming up on a level that it hit last year. That when it hit it, it sort of came back down. So we're going to see some resistance in here. We'll see if it breaks through though. There are spots where you might want to take advantage of it.
I like that. So I want to go back to what you just said. Talk about market breadth. Okay, that's something we talk about with our clients quite often. We discuss it. That's the concerning factor right now. Is like you have very few names that are the majority shareholder leaders in this crazy performance that the Nasdaq's had. So we got a couple of names that we'll go through. Kind of the S&P 500, so the top 500 companies in America based off of market capitalization. So let's look at these returns so far this year. NVIDIA leading the way. Again, they're leaders in the AI. Kind of pioneering phase here. NVIDIA, chip maker, graphics cards, 116.7% so far this year. Meta, which is the former Facebook, up 105%. AMD, another chip maker, graphics cards, 66.6% year to date. Then we got our wrench in there. Royal Caribbean Cruises up 62%.
Speaking of services and how those have been, people want to get out of COVID, right, and go on a cruise.
Travel, especially because the cruises were shut down for so long. Salesforce, another software as a service, kind of the pioneer in that sector, growing in the AI space as well. They're up 61% almost this year. And then you go down to Tesla, Amazon, Google, all up almost 40% or more year to date. So it's proven to your point, right? Like market breadth is a big thing that we're looking at right now. And again, where you're at, depending in your financial journeys, is going to be key. Kind of how your portfolio is built, right?
But again, those same stocks last year were down tremendously, so they're making up a lot of ground. And the stocks that did well last year, your oils. I mean, I'm looking at AMD, right? It's now this year's been down pretty substantial. Tyson Foods, some of these companies that are really quality companies that are down this year that did really well last year. So point is, look, it's really important to have a long-term perspective in all of these things. Those areas that are actually not performing well look to be good opportunities right now. So, the managers we use, and I know in some of the funds, the Capital Group, different groups, they're taking advantage of this as well. And so it's really important to keep the longer term perspective because it'll flow. Trust me, in 1998, 1999, anything that had a .com associated with it, without even earnings, it was flying. I mean, it was like crazy, and it was great until it wasn't great, and then it was really ugly. So, not saying that's going to happen. These quality companies right now in the AI space are good, solid companies. Some of which are paying dividends too, and we own. But point is, you can't get caught up into the momentum part of that. Keep your perspective. Keep your balanced portfolio. It's really important. It'll long term. It kind of all it kind of all levels out longer term and for good returns.
Absolutely. So you heard it here from the maestro himself, Jason Jacoby, Mark Boyer, your closing bell for this week. We'll see you next time.